Dickey here, and one of the questions I get all the time is, what is the stock market going to do? Well, if I knew the answer to that, I probably wouldn't be sitting here doing this and talking to my clients every day. But what I can tell you is that the market's going to do this. It's going to go up, it's going to go down. But more importantly, when I hear people talk about that and get that question, which market? And I know that seems maybe a little off, but here's the thing, and I've got it up on my screen and you can see this here. Just on this screen alone, you've got the S&P 500, you have the Dow, you have the NASDAQ, you have the Russell. Those are just four indexes and markets out there, so to speak, okay? So when we say what is the market going to do, it depends on which market you're talking about. And the reason I want to make this a big issue right now is that at the moment, the Dow is down, let's say around 8%, but the NASDAQ's down 30. So there's a really big disparity there, and that's not normal. Now, what should happen is a reversion to the mean. And all that really means is that when the Dow, the S&P, and the NASDAQ get back to their all-time highs, and they will at some point, or if history is any indication, they should come close to doing it at about the same time. So what's interesting, and I want to show this on the screen here, is that several times over the last couple weeks, we've noticed that the NASDAQ has either made money or been up when the Dow and the S&P have been down, and at least twice and sometimes three times as good. So in this particular case, the Dow is down almost 1%, and the NASDAQ's up a quarter. So, that's a pretty significant difference. But and I'm going to round some numbers here, but if the Dow is down 10 and the NASDAQ's down 30, you're going to need to see that transpire over the next several months if they're going to come and converge, and they should. They should get to their all-time peaks, not exactly, but pretty close to about the same time. So if that's going to happen, you're going to have a day where the Dow's up 1 and the NASDAQ's up 3, and the S&P's down or up, 1.5, because the S&P's down about 20. So, and again, I know those are kind of rounding numbers, but that's what's going on. So here's the question. So why is this actually happening? Now, part of it is we had this huge sell-off. Now, everybody's going to go back to last year in March, whatever. You need to go further back than that. You need to go back to February of 2021. That's when you started seeing these high-flying, we'll call them, stocks that had PE ratios that were, again, non-existent, and you had sales that were, or market values that were just way out of whack. You had a company like Teladoc at $300 a share. You had Salesforce at, $400. You had Zoom at $500. Again, just insane valuations for these companies that have all kind of come around and gone the other direction. Now, they have come down and they've come back the other way. Now, some of them have gone too far the other direction. As an example, and I said this the other day, and I'm, again, not advocating for any particular stock, I'm just giving examples. Was Teladoc ever really worth $308 a share? I don't know the answer to that. What I can tell you that right now, if it's 2.5 times sales and it's still growing at 25% a year, the valuation's there. Now, at some point, they're going to be profitable and they should come around. Again, another story. But some of these stocks have just gone completely the other direction. Now, in order for them to come back, and again, just use it as a pendulum. When it goes too far one way, it has to come back the other way, to get to the average in the middle. And I think that's what's happening at the moment. You've had some stocks that have just been so beaten down so far that they're just being bought because, again, they're good quality stocks, and it's not that they're going to go away. We're not talking about .com stocks from 2000 that are not going to be here next year. These are stocks that, the question is, where is the correct valuation? And some of them have just been pushed too far the other direction because they were pushed too far on the valuation the other side. So what you're actually seeing today, and I mentioned this when I gave my weekly report, one of the things I was looking at on going forward was Goldman Sachs and Morgan Stanley reporting today. And wow, what a difference in these two reports. Goldman Sachs was just horrible, and they're down massively. And then you've got, Morgan Stanley had a stellar report, which thankfully, what's actually happening is the market is responding as it should respond. So again, let's look at Morgan Stanley. And most of you probably don't know and don't care who in the world Morgan Stanley is in the scheme of things. But they had a good quarter. And they're up 7.3% today. Goldman Sachs. They had a bad quarter. And they're down 7% today. Now, I'm not saying buy or sell or whatever. My point is that for the last year, and especially since Powell in November of 2021 came out and said he was going to start raising rates, things have been selling off as a group. So if one stock in that sector did a bad job, or like NVIDIA had a bad day, all semiconductors sold off. If Goldman Sachs would have done this a year ago, all the banks would have sold off. What I like to see happening right now is they're actually giving credit to the companies that should get credit. Goldman had a bad quarter, they get penalized. Morgan Stanley had a good quarter, they're being rewarded. Love to see that. So what you're actually seeing here is that you have the Dow, you have the S&P and the NASDAQ. And the thing I want you to talk about, when we start talking about what's different market, understand that the Dow is only 30 stocks. That's it. Now, a lot of people, when I've talked to my clients about it, they're like, really? How is 30 stocks actually a market? Well, typically speaking, the Dow is more value oriented than the NASDAQ. NASDAQ is going to be more growth oriented. And there's thousands of stocks in the NASDAQ. And the S&P 500 is literally what it says it is. Standard & Poor's has 500 stocks in there. Now, they're not always the same stocks. They do change them from time to time. But basically, that's what you have. There's 500 stocks in there. Now, what is the market going to do? Well, it depends. What's the NASDAQ going to do today versus what's the Dow going to do today versus what the S&P is going to do today? And again, you have the Russell 2000, which is 2,000 stocks. So what matters is what happens in each of those different stocks. Okay, now the NASDAQ has a lot of growth stocks in it. It has Microsoft, Apple, Google, Amazon. All that's in the NASDAQ. Well, not necessarily everything that's in the NASDAQ is in the S&P, and not everything that's in the S&P is in the Dow. Because again, there's only 30 in the Dow. So if the Dow is more value oriented, last year we had a changing of the guard, so to speak. We had a lot of people moving out of growth stocks and going into value. Well, at some point, the value can only go so high. And I mentioned this in a couple of videos earlier. And a part of that was Jim Cramer had mentioned that you couldn't invest in growth because, it's too risky or whatever. And he was making some comments on some of these individual stocks. I mean, this was another company that came out today. Now, what does this matter? Well, Travelers is part of the Dow. And if it's part of the Dow and it's going down 4.8%, that's going to weigh pretty heavy on the Dow. So keep that in mind. The reason the Dow's down isn't because the market's down. It's because the individual stocks inside the Dow are down. The reason the NASDAQ's holding up better is there's a lot of stocks in there that have been oversold. So we are going to want to see this. So even though it's not up much, the fact that the Dow's down 1 and the NASDAQ's up a little bit, that's kind of the inverse of what was happening most of last year. The NASDAQ would be down 3%, the Dow would be down 1. And that's how we've gotten this disproportionate sector where we have, the NASDAQ down 30 and the Dow only down 10 or whatever. But again, they will come back together. I don't know if it's going to be that the Dow comes down 10 and the NASDAQ only goes down 3 and it comes together that way. Hopefully over time what will happen is the NASDAQ will come back faster than the Dow comes back and they kind of converge near the top. But that's what the interesting dichotomy today, and again, we've seen this many times over the last couple of weeks where we're seeing the NASDAQ outperform the Dow and the S&P. And again, it needs to be done. It has to go that way in order for everything to come back the other direction. So, but back to the original question, the market depends on what you're in. And if you're in the S&P, the Dow, or the NASDAQ, or you're in mutual funds, you got to look at your different mutual funds and see what the mutual funds are in. You might have a mutual fund that's tracking the S&P, the Dow, or the NASDAQ, or the Russell. Well, that might make a difference as far as what you're doing. I mean, right now, if you've got a mutual fund that's down 30%, we'll say on the year, it's probably because it has a lot of Russell and NASDAQ in it. If you have a mutual fund that's only down 10, 15, or 20%, then it probably has a blend of the Dow and the S&P. So it may not be as volatile, but it also will not come back as quickly. Because again, the more volatile, it's the bigger swings. If you have something that's less volatile, it's going to have, not that it's not going to go up and down, it's just they're not as big and deep. So if you have something that is following the Russell or the NASDAQ and it's coming back and it might do a 30, 40% return this year. Now, still may not get back to its peak, but again, you have to look at how your portfolio is put together. And this might be a really good time to readjust. Now, I've never been big on telling people, to sell. You don't want to sell at the bottom and, buy at the top and so forth. But sometimes reallocating your portfolio to take advantage of what the market's doing or giving you is sometimes a good thing. If you've got some funds that are not down very much and you can rotate them into something, let's say the NASDAQ, let's say that you've got some cash on the sidelines, or you've had some CDs that come due that didn't go down when the market went down. If you can rotate those into the S&P 500 or the NASDAQ as the market comes back, that's a way to make some really good money without having a whole lot of risk. I mean, granted, there's risk in all investing, but as far as risk in the market, we can talk about the actual risk in your portfolio and how you want to do it. But basically, what I'm talking about today is look at the different markets. And again, these are just the four main ones. There's a ton of different investment options out there. So when we talk about the market, we need to be a little more specific in what we're talking about. Generally speaking, these are the ones we're talking about. It's the NASDAQ, the Dow, and the S&P. So when I'm focusing on my investing of my clients, that's kind of where I focus at. I mean, the Russell's still there, but it's not my main focus. We focus on those three there. So talk to a financial advisor, keep investing for you. And my goal for everyone is to be able to retire when they want to retire and how they want to retire. Dickey out.